Now, again, for buy and holders, it's going to be trickier. But think about what happened. I mean, everyone was buying ETFs that tracked the S&P 500. Everyone, think about how much money was going into that space. And then doesn't it make sense when you get everyone in a trade that it doesn't work out? All right, couple things I want to go over here. Number one, I'm looking at the NASDAQ and the S&P 500 today. And based on this analysis, it's very possible the NASDAQ and the S&P will not make new all-time highs for 10 to 15 years. All right, so I know that may sound earth-shattering to many of you out there. For those of you that are a little older and you remember the dot-com bubble, it took about 15 years for the NASDAQ to make new highs. I want to show you comparisons to charts going back years, if not decades, of why this is likely to occur. And again, this is going to be pretty crazy stuff. But ultimately, what it means is the long-term investor is going to struggle for a while. Remember, the long-term investor has had a great run of it. All right, think about it, just consistent money printing by the Fed. So the long-term investor has seen the markets, every dip has been a buying opportunity. For a very short amount of time, it's been dipping, then it makes new all-time highs. That is likely in the process of changing. And again, the recent all-time highs in 2021 for the S&P and the NASDAQ will likely not be revisited for 10 to 15 years. So what we're going to do is we're going to jump right into it here and take a look at the charts. What we can clearly see here, folks, is that you basically have, this is the NASDAQ chart, and you can see that in 2021, in November, we made our all-time highs. Since then, we've been making lower highs and lower lows. We know that that signals a bear market, a trend change in the market from the higher highs and higher lows that we've been seeing for quite some time over. Now, really what you have to understand here is the Federal Reserve has printed money since 2009, using interest rates as well to go to essentially zero to stimulate growth and avoid kind of any sort of recession. So we really haven't had any sort of major recession in decades, frankly. All right, you could go back probably to 2001, 2002 to the last time there was a decent recession. Now, what does that mean? Well, it means essentially that by printing money, the Federal Reserve pulled forward all the growth and really all the kind of the PE ratios being higher in the near term. So what we can do here is we can go back to 2009. This is when the Fed began printing their money, quantitative easing. And look at what the market did. And yeah, you had little dips for a couple months. These are monthly candles now. But look at how little. I mean, really 2 months down, that was COVID. 3 months down here, and that was the 2018 dip when the Fed threatened and started to raise interest rates, then backed right off. Aside from that, there's really no recessionary period that you can see at all. So what does that tell us? Well, it tells us that now that we have inflation out there, it's going to be very hard for the Fed to go back to their money printing. And what that's going to do is it's going to make sure that not only does the economy and the global economy struggle for years to come, because remember, the economy's been addicted to Fed printing. It's been addicted to this kind of drug known as money, just constant money flow, low interest rates, free money, essentially, easy loans, cheap loans, all that stuff for decades at this point. And that, again, has now ended. And what you can do is you can see that, again, from the easy money beginnings, we had this incredible run to the upside. Now, I want to show you another run that's very similar, and I want to show you what a market did after this. Let's go to the EWZ, the Brazilian stock market. Okay, and what I'm going to do is go and bring it all the way over here and look at the similarities in this run from 2002 to basically 2008. All right, look at the vertical nature of that run. And then again, we can go back to the NASDAQ, all right, and we can look at the NASDAQ and look at the same run. Look at the similarities in this run right here. So see how the gains were pulled forward, the immense, intense gains were just ripped forward. And essentially what you have here is a market with the NASDAQ where now you're going to go in a period of kind of mourning, right? You're going to go, and by the way, this run right here in the NASDAQ was the dot-com bubble, and look at the vertical nature, and then look at the run here and look at what happens. Now, what I want to show you here is going back to the EWZ and look at that run, and then look at how the market has behaved since. Since 2008, you have not had the Brazilian stock market make a new high. All right, you have not. And what that's basically created is, number one, it's a great consolidation pattern that eventually I think will break out. But basically, this tells you that when you pull forward the gains in such a massive way, especially through money printing and free money and low interest rates, which is essentially the same thing, you're going to have this digestion period. So this is the period that I believe we're in right now in the S&P and the NASDAQ. This sharper decline over the period of it'll probably take about a year and a half to cycle out. All right, there's this hope that the Fed will go back to easy money once the economy starts to sputter. But again, unless inflation comes down dramatically, you're not going to see that. So you're likely in this phase right now. You're going to get a big bounce, but you won't make new all-time highs, and you're going to be mired in this for literally 10 to 15 years. Eventually, will the S&P and the NASDAQ make new all-time highs? Yes. But again, it's going to take a lot of time, just like it has on the EWZ. You could also look at the Hang Seng market. It's very similar, a little bit more volatile because it's China. But again, the Hang Seng market is much the same here. As again, we can go here and bring up the Hang Seng index. And what we can look at here, and I'll zoom out on this, is that essentially you had this monster run right here from 03 all the way to 07, and then since then you've just been chopping sideways, right? You made kind of a pivot high right over here, and then you've come all the way back in. So again, there's history showing that when you have high inflation, the governments have to step back from stimulus, and that ultimately causes a long, prolonged recessionary period, and really it puts in a pivot top for decades to come on the markets. All right, now let's go back to the NASDAQ. I want to show you guys this because this is pretty cool stuff. So if we go back to the NASDAQ, what I was doing was I was looking at the similarities between the dot-coms, right? And what we could see here is if we go back to basically right here, right? So this would be the start of the dot-com run. And again, look at how the dot-com run starts slow, upticking, I mean, pretty gradual up, and then it gets more and more vertical, and then it just spikes up. All right, now what I want to do is I want to go to the current period in the NASDAQ. Look at how you started slow, 2009 low. You started grinding up. Then you get steeper, and then vertical. See the similarities in there? Now look at this. Here's the dot-com high, which was in 2000, March of 2000. And again, we made a low in 2002 October. So what that does is it gives us an idea about how long until we actually put in a potential low on this market. So we still, honestly, we have about another year to go of downside at minimum before the market makes a bottom. All right, so we're basically 1 year in, give or take, from the all-time highs, just like here, 1 year in. Look at this, 1 year in was right over here. All right, so you still have quite a bit more downside to go. In fact, in terms of percentages from this high of 2000, you have basically 50% downside to go. I mean, it doesn't look like that much, right? Because you had such a big drop here, but still another 50% downside in the NASDAQ 100. All right. Now, a couple other things to go over. What you can see here is that this run here, we went from basically 350 to 400. So you went, let's call it 400, right? So the bull run started around 400 here on the NASDAQ 100, and we topped out at 5,000. All right. Now, if we go here, was that percentage, so a little over 10 times, right? It was basically 12 times. And what you can see here is that you started around 1,300 and you went to 16,000. Well, 1,300 to 16,000 is about 12 times as well. So you see the similarities. The bull run here was approximately 12 times, 12x, essentially 12x to the NASDAQ here. And then essentially right here from the beginning of the bull run, which started in 1990, you basically 12x'd as well. Now here you could also make a case that we started the bull run in 1990, all right? You topped out in 2000. That was approximately 10 years. Now, if you look here from 09, we actually topped out in 2021. That was a 12-year move. Now, part of that, do I think it was COVID-related stimulus, the reason why it was slightly longer? Yeah, I honestly do think. I think the immense, printing of money from the Fed because of COVID and because of the government, the U.S. government sending checks, it probably elongated the cycle by just about 2 years. And again, think about COVID was 2020. When did the market stop? Basically late 2021, almost 2 years later. So you could argue that we were basically topping in the market here, all right? And then you had the elongated cycle for an extra 2 years. Now also look at the topping candles. Look at this candle here and look at this candle on the monthly chart here. Now, this one's a topping tail, this one's a doji, but either way, they're very similar. And then look at the vertical nature of this market fall. All right, so you have these similarities in the charts, and essentially what you have to do is you have to lean back and you have to look at history. And this is what I've done in so much of my analysis of going back to history and saying, okay, well, number one, how long did it take for any market to bottom out? Right, so you could look at the NASDAQ, it took 2 years. Now, remember, this was an elongated cycle, so I would say 2 to 3 years is what it's going to be on the downshift. Okay, now how low are we going to go? Well, you basically have at least another 50% here, which would take us down from this low, which was about 10,000 on the NASDAQ. You have us taken to about 5,000. Now, where does that put us in terms of a top? Well, interestingly enough, look at this. We have the high of the dot-com bubble is right around 5,100. If you did the same analysis and said, okay, let's see, the breakdown was another 50% here, 50% gets us essentially back to this pivot top from the dot-com. So that's a confluence of technicals alerting us that we'll likely see a drop, all right? But in addition, what you have to look at is say, okay, well, from the dot-com high, how long did it take us to get back to new all-time highs? Well, right here is where we made new all-time highs, from 2000 to 2015. So basically 15 years. So what I'm thinking here is, in addition, right, let's look at this. All right, now let's go back to the EWZ. All right, now on the EWZ, how long has it been since we topped out in 2008? 14 years. So is it possible that the Brazilian market is getting ready to pump here and break out? I'm not sure, but I certainly think that that's interesting. But notice the time from this top to where we are, 14 years, from where you saw the NASDAQ in 2000 to when it finally was able to break out and make a new all-time high, it was 15 years. So it gives us a year here where it wouldn't be shocking on the Brazilian market to see a break to the upside. Much the same, guys, in the Hang Seng market as well. So again, these are the things that we want to look at. Here's the S&P 500, much the same. Look at the bull run, how it starts slower, then it gets more vertical, and then really vertical. And then same thing here. This is just a smaller variation of that same move. And again, what I do think is it's very likely that the S&P 500 as well as the NASDAQ will not make new all-time highs for 15 years. So there's going to be a digestion process here. Now, the positive is, and this is the key, guys, and I always like to leave you with a positive because I'm a trader, right? I'm in, I'm out. I see positives, I see negatives. What for me is most impressive here is that, yes, the retail investor who's a buy and hold is going to struggle. But number one, there's always opportunities. I brought up Brazil, maybe China. There will be U.S. stocks that do exceedingly well in this period. But also keep in mind that if you look at the Brazilian market, if you look at the Hang Seng, even since they haven't made new all-time highs in decades, you have to say that there were major bull runs inside of the bigger macro bear. And so there will be opportunities. It's going to be a swing traders market here over the next decade to 15 years. That is going to be very good for people that are nimble, that are looking for major technical levels that bounce. So chart readers, technicians, this is where your bread and butter is. This is going to be one of the greatest periods for swing traders that we have experienced in my lifetime, in my opinion, over the next 10 to 15 years. Now, again, for buy and holders, it's going to be trickier. But think about what happened. I mean, everyone was buying ETFs that tracked the S&P 500. Everyone, think about how much money was going into that space. And then doesn't it make sense when you get everyone in a trade that it doesn't work out, right? Think about that. Now think about Bitcoin. Everyone got in at 65, 69,000. What happened? It didn't work out. So you have to look at these psychological sides as well. Anyways, I don't want to keep you guys too long. Just my 2 cents here on where the S&P is, where the NASDAQ is, where we are compared to history, whether it's the Brazilian market, the Hang Seng market, the dot-com bubble. All of these are great reference points. And you, by the way, you can go back to the 20s. Go back to 1920s, the Great Depression, the Roaring 20s. The charts are eerily similar. All right. And again, you can look at how long it took in the Depression to make a high before the markets obviously bottomed as well. Things like that, very, very important. How long did it take before we made new all-time highs during that period? Fascinating to look at history. Remember, folks, we are humans. We run on emotion. Humans by nature are emotional. Therefore, we tend to repeat emotional mistakes. Greed and fear rules the day. Doesn't matter what asset class, there's greed and there's fear because humans are the ones trading, they're buying and selling. So this is why historically we're doomed to repeat these issues because again, greed will always come in. Doesn't matter if you're in the 1920s, in the 1970s, in the 1990s, the 2000s, the 2020s. Greed will come back in.